Scalping is basically in and out trading style. Trades are usually exited at 30% of the average daily range or a DRM short of the market pair. Fast execution and precision is required to utilize this particular strategy. Time frame of observation is going to be M15 and it can be applied on all tradable assets except indices. Let's dive right into the procedure. When we are trading, we know that there are market makers behind every price movement. These market makers will always start by looking at where to start their push. Is it this part, or is this part, or is this one? However, we'll need several indicators to help us identify the starting points of the market makers. So I'm going to install indicators on my charts so that it will be easier for me to find these starting points. Go to indicators, then we search for moving average exponentials. One, 2, and 3. We only need 3 moving averages. Here are the parameters for each moving average. The first one, we're going to set it to black. And on inputs, we're going to put a length of 200 EMA. Basically, this is period, source, close, method, EMA, and then that's it. The second one, length of 13, source, close, method, EMA, style, we'll actually put red for its color, and then the last one, length 50, source, close, method, SMA, EMA, style, we'll put blue for this one. So we now have 3 EMAs on our charts. The black one being a 200 EMA, the blue one being a 50 EMA, and the 13 one in red, like that. So after doing this, the first initial point that we need to do is to locate a starting point for the market makers. This is basically a point whereby the market went to the 200 EMA, which is the one in black. That is a point of market reset. After that, we need to see this particular crossover of the 13 EMA, the one in red, and the 50 EMA, the one in blue. After that, we need to actually see a bounce of the price on the 50 EMA. And then we see a candlestick closure on the 50 EMA, which is at this particular point, enter and make our 2-to-1 reward to risk ratio. Let's have more examples so that we fully understand. We've said the first thing is to see a bounce of the price on the 200 EMA. The next step is to see 13 EMA crossing 50 EMA. Then the next step is to see a candlestick closure above the 13, or basically a candlestick reversal pattern, which is this one. Our entry is actually at that particular point, and our exit at 2-to-1 reward to risk ratio. Most of the times when we have such a scenario, the market will actually do what we are expecting. We can see a crossover, a bounce of the price on the 200 EMA, crossover of the 1350 EMA, and then a retest of the 50 with a candlestick reversal pattern, and then our profit at 2-to-1 reward to risk ratio. Basically, in summary, we are saying we need to see price bounce on the 200 EMA, price giving us a 50 13 EMA crossover, and then price returning to the 50 give us a candlestick reversal pattern, or basically a candle closure above the 13, and our take profit below structure, our stop loss below structure, our take profit at 2, at reward of 2. Basically, that is what we will be looking for. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.